Hi there, my name's Ben Rogers and I'm a financial planner here at Equilibrium. And today I'm having a catch up with Associate Financial Planner and Chartered Tax Advisor Mark Tan, or as he's affectionately known in the office as Taxman Tan. And we're going to be catching up regarding Jeremy Hunt's budget last week. Now, safe to say, certainly from an investment point of view at least, this budget feels somewhat uneventful to what we're used to in recent months after the UK's brief foray with Trussonomics. And whilst markets have been fairly muted, mainly due to the fact that most of the key changes were well flagged ahead of the announcement, there were a number of changes from a tax point of view. So I'll be asking Mark to help me dissect the key changes in the budget that we think might be relevant to you, our clients, and then I'll jump in with any planning angles that we might want to look at. Now, there was a lot in the budget, so we'll be focusing on four key areas. First of all, working taxes. So this is how I would class as things like income tax, pension allowances, impact on business owners. We'll be looking at what impact any changes might have on your portfolio's efficiency. We'll touch briefly on landlords, and we'll finish by just having a look at estate planning and any impact on inheritance tax. So, Mark, let's get going. So, starting with what could be classed as those working taxes, what did the budget have to say?
Well, thanks, Ben. So this autumn's budget definitely contrasts with what was announced in the mini budget or special fiscal operation, whatever you want to call it. So with the government having already reversed proposals made by Kwasi Kwarteng, with the main one really being the removal of that 45% additional rate of tax. So rather than seeing the additional rate of tax being abolished, we're now heading into the opposite direction with a reduction in the threshold from £150,000 to £125,140. This essentially means that 250,000 more people will now fall into this tax band. So HMRC is expecting to collect an additional £13 billion by 2028 as a result of the personal tax measures announced in the autumn budget, which of course is a huge take given the cost of living crisis and below inflation pay increases. What we also saw, Ben, was a freezing of the basic rate and higher rate thresholds for a further 2 years, and the cuts in certain allowances, such as the dividend allowance and the CGT annual exemption. This gives rise to something called a fiscal drag. So essentially, this is where tax receipts rise because the tax bands are not increasing in line with people's income, be it wages, pensions, or rental income.
Yeah, this concept of fiscal drag is actually really interesting because we see it across this whole budget in a variety of key allowances and thresholds. And it's this idea of stealth taxation. You know, if we leave the allowance unchanged, then over time, as wages, income, asset values increase, more and more people fall into these higher rates of tax. I saw somewhere that around 15% of adults are expected to be higher rate taxpayers at some point over the next 5 years. So as a planner, for me, it highlights the importance of that income tax planning each year. And that conversation generally starts with looking at pension contributions, particularly those for whose income is coming up towards what we would class as tax trap areas. So a great example of this would be for those with earnings over £100,000, they lose £1 of their tax-free allowance, their personal allowance, for every £2 that they earn above 100k. And this means you're essentially, for those that between 100 and 125,000, you're essentially in a 60% income tax trap.
Exactly, Ben. And one positive point to note is that for people saving towards their pensions, what was that tax relief is still applied at their marginal rate of tax. So there's no introduction of a flat rate as had been tipped before.
Yeah, so to be fair, this is now my 14th budget, and I'm pretty sure the abolition of marginal tax relief has been tipped at every single one. So you've always got to take tipsters with a pinch of salt, if not a shot of penicillin. But it is a really good point in that, especially for those who are earning between 125,000 and 150,000 pounds, who are going to get caught by this new lower threshold, then there's really an argument to say that actually, could you look at delaying personal pension contributions. So not talking really here about employer matched contributions, but if you're making an ad hoc contribution and your earnings are in that band, you could wait until next year, utilize that carry forward allowance, and ultimately receive 45% tax relief rather than the current 40. So pensions were also mentioned in the budget. So what news on that front, Mark?
Well, there are two main allowances, Ben, when considering pensions. So there's the annual allowance. So this is basically how much someone can put into their pension each year. And something called a lifetime allowance, which is how much you can accumulate overall. So both of these allowances have been frozen at the current levels until 2028. This means that contributions are capped at £40,000 a year, and the lifetime allowance is capped at £1,073,100. And again, this is under the form of stealth tax, as anything above the lifetime allowance is potentially taxable at up to 55%.
Yeah, and this is again is a really interesting one, especially given the recent fall in markets over the last year or so. There's a real chance that people could actually be lulled into thinking that they've got more headroom than they do, particularly if you start to factor in, regular contributions over the years and a recovery in markets. You could really start to see people butting up against that lifetime allowance. So it's really important that we get a realistic sense of when that might be and when you might start to come up against it. But it also means that as planners, we might need to start looking outside of pensions at some alternative tax planning vehicles a bit more, particularly for those facing, with larger income tax liabilities, but also hitting those frozen limits on pensions. So the likes of venture capital trusts or VCTs, where you get a 30% income tax reducer on investments up to 200 grand, in addition to tax-free growth and dividends. But there's some really exciting ways that we can use VCTs. And we need to make sure that they are an investment first and they are higher risk because it is venture capital. But there's some really interesting ways we can use them to add another string to people's kind of retirement planning. And I suppose while we're on this kind of working tax section, it needs to be mentioned about corporation tax for business owners, because this was a real will they, won't they. It looks like things are moving ahead now. So corporation tax is currently at 19% on profits across the board. However, from April next year, corporation tax is going to be increasing to 25% for profits over 250,000. And there's also a marginal rate for profits between 50 and 250. So it's really important that if you're a business owner, that you speak to your company accountant, engage with your advisor, because there are some steps that could be taken ahead of April. Bringing forward profits wherever possible, delaying any capital expenditure till next year, and certainly employer pension contributions are looking a lot more attractive in the next year, where you're getting a tax saving of around 25%. So worth having those discussions ahead of April. So Mark, moving on to our portfolios, what budget items do we need to be aware of there?
Well, one of the big changes, Ben, was around capital gains tax. Now, again, it wasn't quite as bad as the tipsters suggested, as the rates have stayed the same. However, we have seen a reduction in the capital gains annual exempt amount. So this is the level of capital gains that we can all generate each year without giving rise to capital gains tax liability. So in the current tax year, this is at £12,300 for individuals, but this will be reducing down to £6,000 in April 2023, and then again to £3,000 the following tax year. So really, where possible, ensure that you use this year's exemption. And also with the annual exemption, it's a use it or lose it basis. So you just need to make sure you use those. And also, if you're married, just remember that you can also transfer between spouses tax-free to utilize each other's allowances also. And if you do have any losses this tax year, it may be worth crystallizing losses, which can then be carried forward to use against future gains. And what we also saw, Ben, was a reduction in the dividend allowance for investors. This is currently £2,000, but this will half to £1,000 from April 2023. and this will again reduce down to £500 the following tax year. This is after an increase in dividend tax rates in the last budget. So reduction in annual exemptions will bring more people within the scope of these taxes, and it will actually really result in increased personal tax return compliance for individuals.
Yeah, and I think this highlights a real challenge for a lot of investors, just generally when they're trying to dovetail their investment management and tax efficiency. Because say you've got a portfolio of 30 individual funds, each of those individual funds would have their own capital gains position. So if you want to make a switch between funds because of an investment decision, or even just rebalance, you run the risk of actually incurring a capital gains charge. And I suppose this is one of the key benefits I find of managing our clients' money through the fund structure, because Mike and the investment team can make as many switches or changes to the funds as they like, and it doesn't give rise to a capital gains event. Unless that client actually sells the fund, all of those internal switches don't have an impact. And I think it's also really highlighting across this budget, really, the importance of diversification. We often talk about diversification in terms of investments, but we can also incorporate tax diversification. When we construct portfolios, we want to use a range of different wrappers. So not just pensions, but also ISAs. Now the allowance for ISAs stayed the same, which is a positive, but also using general accounts to generate those capital gains and bonds, as well as VCTs that I mentioned earlier. And so by having a diverse range of tax wrappers, you can almost have different taps that you can turn on and off again when you're looking to generate an income from a portfolio. So what news for property investors, Mark?
Well, it's been a tough 5 years for buy-to-let landlords from a tax perspective, with a restriction on mortgage interest relief, and also the 3% stamp duty land tax surcharge that was introduced not long ago. Although there's no specific measures introduced for landlords, the reduction in the annual exempt amount for capital gains means that more of these gains will be taxed at the higher CGT rates of 18% and 28%, which apply to residential properties. So for those already considering selling an investment property, it might be worth bringing this forward to the current tax year. And for a high rate tax paying couple, this would save over £3,500 in capital gains tax. And again, also make sure you're utilising spouse's exemption wherever possible.
Yeah, I think making sure you're utilising all of those available allowances has been a really key point highlighted from this most recent budget. So just to finish up, we'll do a short word on estate planning then. So any news on the inheritance tax front, Mark?
So yeah, so in terms of inheritance tax, they have frozen both the nil rate band and the residence nil rate band for a further 2 years, which means that they will remain at their current levels until April 2028. And this would mean that the nil rate band would not have increased since 2009. And it's actually estimated that it will increase states paying IHT from 25,400 in 2020 to 47,700 in 2026, increasing HMRC's take from IHT by about £2 billion in the 2026-27 tax year. Another point to mention, though, Ben, is the tapering of the residence nil rate band, which will remain at 2 million, which just means that more and more states may not be able to use their residence nil rate bands.
Yeah, and again, it's another one of these sort of stealth taxes, fiscal drag, whatever you want to look at it. But it just means more and more families are potentially going to be falling foul or starting to find themselves with a potential inheritance tax liability. Now, I can talk about, as you well know, I can talk about inheritance tax all day because there's just such a wide variety of ways that you can address it. But for me, the budget really highlighted the importance of intergenerational planning.
Yeah.
Because in short, intergenerational planning is not just focusing on saving tax, but also how your money can have the biggest impact on those you love, getting it to the right people at the right time. And the good news is that if we take an intergenerational approach, then it can actually mean you end up with some really significant tax savings, not just from an inheritance tax point of view, but also for the family. One of the things we spoke about earlier was tax traps, and that 60% band for those earning between 100 and 125,000. But there's also another one between 50 and 60,000 pounds for family with young children, where they begin to lose their enticement to child benefit allowance. And we mentioned earlier that one way of combating these income tax challenges and some of the planning there is to use pension contributions. But again, with cost of living pressures, a lot of these families aren't necessarily going to have the free capital to be able to fund these pension contributions. So if we can start to look at incorporating pension planning into an intergenerational inheritance tax planning, not only can you save 40% inheritance tax, but you can actually end up saving the next generation 40 to 60% of income tax, and maybe even restore their entitlement to child benefit. So again, there's just some really interesting angles that we can start to look to incorporate if we take that intergenerational approach. Well, first of all, thank you, Mark, for joining me today and running through the budget last week. Hopefully that has given everyone a bit more insight into what the budget might mean for them. As always, if you have any questions or you want to discuss any opportunities or challenges that might be facing you or family members through following the recent budget, please do not hesitate to get in touch. We are on the other end of the phone and here to help. Thanks, Mark, and thank you everyone for watching.